target are supposed to do with the proposed transaction. So while this has become a board meeting agenda, do they have enough information? Are they able to take a good business judgment? We are somewhat lucky that the decisions of the boards for mergers and acquisitions are not yet being challenged by shareholders, partially because of the speed with which our judicial remedies work. If they were working as swiftly, as efficiently as in the US or in some other jurisdiction, surely a lot of stress could be felt by the boards as to how did they take the decisions of mergers and acquisitions, particularly what kind of due diligence has been undertaken by both the target as well as the acquirer. So before taking a decision that yes, we will proceed, did the board have adequate information? Did they have enough intelligence? Did they have information which is updated enough? Did they have enough commercial intelligence available to them to decide whether they should proceed with the transaction or not? Because ultimately it is the board which is first in the line of fire, because it is the board decision to proceed with the transaction. Remember, the minutes of the meeting are the only document which can demonstrate to the whole world what was considered, what was debated, who voted in favor and who voted against. So if there are directors who are not comfortable, again as a matter of the mandatory governance requirement and the secretarial standard, you need to voice your opinion at the board meeting, come what may. Please look at the next statutory obligation cast on directors under 166. Directors shall exercise power with due and reasonable care, skill, diligence and independent judgment. It's statute, it is no more theory. They must act in good faith, they must promote objects of the company for the benefit of members as a whole and in the best interest of the company, its employees, shareholders, community and protection of environment. And obviously we cannot have a direct or indirect conflict. Now just consider a situation where you are acquiring a target which has already reported some drawbacks, deficiencies in internal financial control. How are you going to decide that item as an acquiring board that we are sharing an audit report which shows serious deficiencies in internal financial controls? Remember, you proceed with the transaction, the year is over. Now you are sitting on the board of the consolidated entity and you are required to now certify that the internal financial controls are adequate to not only prevent fraud, not only detect frauds, but also to prevent frauds. So just 1 year before this consideration, the target which has merged into you, the target which you have acquired and is not consolidated into you, has already reported that there have been systemic drawbacks. What is it that the board is then going to do in that 1 year period so that when it comes up for the next consolidated consideration, what will you report on the IFC standard? So that is going to be somewhat challenging. So it's not merely completing a transaction. It's not saying that we acquired one of the biggest mines in India. It's not good enough to say that we acquired 10 units all across India in one single integrated transaction. What is your responsibility as a board is far greater. Please remember, with all the amendments that came to mishaps, whether it's a Satyam scam, a Sahara scam, a Shraddha scam, or a 2G scam, whichever scam it may be, it has kept on adding a very, very serious responsibility on the boards. So it is clearly not for the light-hearted. Number two, as a target, when I look at that provision, that I will offer my company for due diligence, and offering the due diligence to a potential acquirer is in the best interest of the company. Is a stakeholder entitled to challenge their decision? Remember, the best of the value for a business can be offered only by a competitor. You are going to offer under whatever norm, confidentiality and non-disclosure agreements, howsoever watertight they may be. Clearly, you are exposing your extremely sensitive, confidential data to a competitor on a platter in the hope of a transaction. Suppose the transaction does not go through and the competitor eats up half of your market share in the next 2 years. Is a stakeholder in a company entitled to challenge that your decision to offer the due diligence was not in the best interest of the company? Here is the proof that the competitor had access to all the data, all the confidential information. It was used by the competitor. Sorry, no redress possible because it can never be demonstrated how the sabotage happened. So can the shareholder then go to court and say, sorry, this decision taken by the board under the prevention of insider regulation to offer the due diligence to a potential acquirer was wrong. How are you going to defend yourself to say that no, it was in the best interest of the company? Maybe the company was in such a situation that to take it, either sustain that business or to take it to the next level. We had no choice but to get a new promoter in. So maybe it's a lot more fact-based, but the point that I am trying to make is that even your decision to allow due diligence can be questioned regardless of whether the transaction is successful or not successful. So, what I have pointed out is just a statutory duty.
If he makes a disclosure, then company can go ahead. No? What's the problem, sir?
So, it is only a disclosure.
If there is a particular agenda, he should not participate.
That is correct. And now you are supposed to attend a meeting where business is being considered.
Right.
But please look at all realistic situations. Okay, as a significant non-independent director, I have disclosed that interest to the whole world. At least I am conflicted. Because let's assume that it's a related party transaction. Are the independent directors or non-interested directors capable enough to have a strong spine to say that no, this transaction is not good for the company? And that is where the real metal of directors will be exposed. That merely because the interests or conflicts are known, does that make the board nervous, or does that make the board more aggressive? Does that make the board more informed as to how the decision should be taken? Are they scared that they will be kicked out if they refuse the decision? To be honest, that they are not worth being called independent directors. So moving on with the challenges in law in M&A. Remember, the insider trading regulations are not isolated under SEBI. The liabilities, if at all, they come on the directors or anybody who is an insider, will come under both the SEBI laws as well as Companies Act differently. So there are distinct penalties. So if you have 50 crores in your pocket just as a back pocket change, be happy to do all kinds of questionable transactions. But remember, SEBI regulations and Companies Act both will hound you if you are found to be deficient in any of the insider trading transactions. try to analyze some of the stamp duty aspects. Some very basic principles. Stamp duty is nothing but tax. So one element which we never like. Nobody likes to pay tax. This is where you find some of the most aggressive transaction structuring to somehow not avoid tax but to evade tax. And that is where it is not just ethical, but your lawyer has to be really firm to say that please be aware that this tax will fall on you, if not today, certainly tomorrow. And when it falls on you tomorrow, it will have legal implications, it will have interest implications, and it can also invalidate in terms of enforceability. The document will not be admissible in evidence. So what are the fallouts of non-payment or short payment of stamp duty? That needs to be very clearly borne out to the decision makers that if there is any short payment or if there is a non-payment of stamp duty of an appropriate value, then surely it can put your entire transaction into a serious enforceability doubt. One thing to remember that it is a tax on instrument and not a transaction tax. So it is not a tax on transaction but tax on instrument. Only such instruments which are listed in the schedule of the stamp tax. So there are 9 instruments which are still residing under the Indian stamp tax, like the property forms and receipts and the promissory notes. But most of the other instruments that get exchanged in any commercial world are part of the state jurisdiction. So state stamp laws will decide whether and to what extent these instruments need to be charged to stamp duty. If you do not find a description of your document in the schedule of the stamp act, then only you should consider yourself very, very lucky that no stamp duty is payable. There is probably only 2 examples of such an instrument which does not find a place in the stamp act schedule. One is a will, the other is any other testamentary instrument like a codicil. And the reason why these instruments world over are never charged to stamp duty is because they do not create, modify or alienate or extinguish any rights presently. It is only a probable situation that you are documenting through a will or a codicil. And therefore, look at the nature of the instrument. The closest of the description that you will find in the stamp act schedule, and you have to look at the stricter interpretation that most of the documents will be in the nature of agreements. But does that mean that every agreement will fall only under Article 5? The answer is no. You need to therefore find what is the most appropriate description which is closest to the content of the document. So it is not the nomenclature, not the form, but really the substance of the instrument that needs to be tested as to which article you will be stamp duty under. So if there are instruments covered by different articles, clearly you need to aggregate the stamp duty. If there are multiple clauses, say for example, every commercial document will have an arbitration clause. At your choice, if you want to have a separate arbitration agreement for the transaction, so be it. But if you do not want to include just the arbitration clause in your agreement, clearly that clause constitutes a separate arbitration agreement apart from your main transaction agreement. So you can look at 2 articles, both the arbitration clause in the schedule and the agreement clause in the schedule, and then aggregate the stamp duty relating to those 2 instruments. Similarly, on indemnity provisions, if there is an indemnity, you will also top up the stamp duty to the extent whatever is payable on indemnity as per the local stamp act. When is the stamp duty to be paid? It is to be paid before the first pay is put to paper. The answer is very simple. Before a first execution, so there may be multiple parties who execute the document, the stamp duty needs to be paid before the first signature is affixed to the instrument. What happens then if the instrument is going to get executed in multiple states, multiple locations? You have to look at the first execution, pay the stamp duty in that state, then it goes into the next state. Please look at the article which is relevant in the second state. If there is an additional stamp duty obligation, that incremental stamp duty needs to be paid before the second party puts the signature. Why? Because each state stamp act will say that in my state, this is an instrument which has been partially executed outside the state, but it is not yet first executed in this state. So before it is first executed in this state, I need to top up the stamp duty if there is a differential between the two states. Does that mean that if you have paid the highest and it goes to the next state where there is a lower stamp duty, nothing to be done, you can just sign it and pass it on to the third location? There may be instruments which are signed outside India. You have 3 months period to take it to the stamp office and get it stamped with whatever. Wherever the instrument enters first, that will be the state in which it needs to be stamped first. So let's talk about what happens with different types of transaction documents as regards to stamp duty. Slum sale, I think under the Income Tax Act, it's a very commonly known structure of the slum sale, which is business transfer as a going concern. So it includes assets, liabilities, contracts, employees, receivables, payables, everything. It is an integrated whole of your business undertaking that will get transferred from the seller entity to the buyer entity. So slum sale, one word of caution, there is a tendency to usually take away some elements of that and just try to interpret that as a slum sale. That can lead you to a serious challenge whether that business which is being transferred as a going concern is really the integrated whole or not. So when you are trying to pull out elements of a ongoing business, be very, very careful that these withdrawing these elements from the definition of undertaking or withdrawing these elements from the as a part of the transaction, does that really compromise the whole concept of an ongoing concern? So that is one observation that we have all across the transaction, that whenever there is a slum sale, there is a tendency to pull out that I don't want to sell this asset, I don't want to give away that contract, I don't want to offer these employees. Now, when you are pulling out from elements of business, does that then the residual part of the business, which is subject matter of a transfer, is that an asset transfer? Is that an assignment of contracts? Are you just trying to aggregate those different transactions in one document? Or is it just one transaction of an integrated transfer of business? That becomes an interpretational issue. And when it comes to any interpretation by authority that this seems to be a mix of transfer of assets, transfer of employees, transfer of contracts, transfer of liabilities, the stamp authorities will be very, very pleased because now they have a possibility to look at 5 different articles, keep on adding the stamp duty and say, thank you very much, you did not pay the stamp duty on these elements. The VAT authorities will happily pounce on you, saying that clearly stamp authorities have treated this a part of this transaction as an asset sale, where is my VAT tax liability. So when you look at any slum sale agreement, be very careful in defining how the business or the undertaking is defined. There is also one very risky proposition when you look at the composition of the business split into immovable and movable property. So this element of how stamp duty is to be considered in a slum sale situation on movable and immovable, that has been dealt with by Supreme Court way back in 1988 in Duncan's Industries versus State of UP. That's a very, very old historic judgment which we need to keep on reminding ourselves that it is not appropriate to artificially split your asset register hypothetically into immovable and movable. You have to consider a situation that whatever is fixed to earth, just because theoretically I can unfasten a whole furnace and remove it, does not make it movable. That's an extremely aggressive posturing before the stamp authorities. I don't think it will jail, because what you are transferring is not an asset, but you are transferring a business as a going concern. Therefore, you are virtually handing over keys of a running business to the buyer. Nothing is supposed to change, nothing is going to physically hand over as assets. So what the Supreme Court has happily also interpreted to say that if something is fixed, for example, a lathe machine is fixed to a platform, it is fixed to the platform for a functional efficacy, not because it was intended to be fastened to earth. So if there are elements of movable property which are fixed at a certain location for a greater functional efficiency, then that is not to be again artificially interpreted as removable. You can very well take that call, but there has to be a very clear objective assessment, a very pragmatic assessment of what can be treated as removable and what can be concluded as movable. In mergers, demergers, the conveyance definition is very clear in most of the stamp acts. The incidence of stamp duty is on the order sanctioning the scheme. There are similar provisions included in the definition of conveyance regarding the merger of banks. Wherever you have a 44A order under the RBI Act, that is also treated as a conveyance. I think all the debates that started with Mitaka judgment way back in 1993 and even Hindustan leader just before Mitaka judgment came in, all those have been put to rest by a statutory change. Some of the later judgments, of course, which propound or rather reconfirm the same legal principle that stamp duty is attracted by the instrument which is the order of the court or order now of the NCLT. Please do not be under the impression that the Stamp Act has not been amended to say that the order of High Court does not include the order of NCLT. Please remember the state has powers to retrospectively amend that. Intent is very clear. No merger is going to get away from the stamp duty obligation just because the authority has moved from High Court to NCLT. Please do not be under a misconception of strict interpretation of law, because that is never the intent of giving away the stamp duty on a merger just because the authority has moved from NCLT, from High Court to NCLT. I am sure the statutory amendments are in the orbit. The other restructuring legislations that you may have to consider is, of course, taxing. There will be restructuring of IPR, which is trademarks, patents, copyrights. There can a serious valuation principle. What is the methodology that you want to deploy for valuation of removals comes in. Some recent interesting judgments, when orders are passed, this was passed by a full bench of Bombay High Court on stamp duty on High Court orders to sanction the schemes. So when you have two registered offices located in two different locations and you have filed two different petitions, there are clearly two different orders that get passed by the two authorities. Yesterday the High Court, today probably the two NCLT benches. If there are two distinct benches, surely you will have two distinct orders which are distinct instruments chargeable to stamp duty in isolation of each other. The Bombay High Court full bench has very clearly concluded that if there is an order in Gujarat and there is a separate order in Bombay, clearly both of the orders under two respective state laws will become chargeable to stamp duty. So just because this is one scheme does not mean that we will not get taxed in multiple states, one of the possible commercial solutions that is being considered and devised in certain transactions is where you move the registered office to a beneficial state. Now that does not still eliminate the possibility that when assume you have still a merger order in one state, you have paid the stamp duty. Now your assets are lying, your immobile properties are lying all across India. What is the instrument that you will carry to mutate the title in other states? It is still the same order of High Court that you will take to Delhi, to Tamil Nadu, to Punjab to say that please mutate my title. The seller entity is no more in existence. Please record the purchaser as a title holder. There is no reason to believe why authorities will not treat this as a conveyance under the local laws. So when you are advising clients, please beware. There is no jurisprudence today to say that just because order of High Court sanctioning the scheme has been stamped in one state, will not get stamped all over again for the value of immobile property where you want to mutate the title in the other state. You can possibly have an argument that I must get at least some remission of the stamp to the extent of stamp duty that I have paid in one state. Now whether that will really gel with all the states, just imagine the situation that Bombay High Court has passed the order sanctioning the scheme and you have assets in all 28 states. Are you going to say that I have paid 50 crore in Maharashtra, that is the maximum 25 crore in Maharashtra, which is maximum stamp duty payable on merger, and I have assets all across India. If I were to do a conveyance, the stamp duty would be 500 crore. Am I going to claim the remission of 50 crore against each state? Obviously, they will want you to file an undertaking that you have not claimed such a deduction or